Hey, this is Dan Betzel. I just want to say happy Friday. I'm getting ready to close down the office. And I wanted to send out a video, and I was trying to think of a clever title. Maybe one clever title possibility would be, do my returns really suck? Or maybe a nicer way of saying the same thing is why your returns maybe not be what you want. So, we all know that markets ebb and flow and markets experience upward and downward volatility. However, I've noticed, in my years as working as a financial advisor, that there are two times in the investment cycle that are particularly destructive or potentially destructive for investors. They're when markets at an all-time low, like in 2008, and like it is now when markets are really, really up. So, as you know, markets are at an all-time high, and this should be a cause of great celebration. However, many investors fall prey to what Greenspan called irrational exuberance, and they allow their current emotions for greater return, or maybe what I could gently call investor greed, to get the better of them. Over the last couple of weeks, I've spoken with several investors who have experienced what I call portfolio remorse. They're sad because their portfolio is 50% equities and 50% in fixed income, is up only 10 or 12 or perhaps 13%. They say things like, well, I was speaking with my friend and they told me that in this market I should be expecting 20 and 25%. But this thinking, I fear, is causing some investors to potentially make some poor decisions and chase returns. When an investor says, my account should be doing better in this market, I worry that the investor really doesn't understand that wealth is created by a consistency of returns and not chasing the highest return possible in a given relatively short economic period. So I'm looking here at last quarter's returns. Irrational equity emerging markets was up a staggering 36.75%. Wow, what can you say, right? 36.57. Now, every portfolio that I manage, it has some exposure to this asset class. However, one of the costs of diversification is that you also have fixed income or bonds in your portfolio, which are going to mute or balance out the higher performing asset classes. But I'm afraid that in today's environment, there is danger that some investors may repeat the same mistakes as the past. When stocks going up 19 out of 20 quarters, it can be very easy to ignore the downside risk of equities and try to ride the current wave of excellent returns. But I think that prudent investors do well to choose a financial strategy and stick with it. Chasing performance and taking on additional risk because the market is up is certainly a risky game. Historically speaking, it usually reduces an investor's real return. So consistency of returns may be boring, but I believe it's the most prudent way to build wealth over time. So please contact me if you want to discuss your portfolio. Thank you again, and I hope you have a wonderful weekend.